Hello, everyone, and welcome to the Dorsey Wright Tuesday video. I'm Eric McArdle, and with me is Sara Mehle. And, nice long Memorial Day weekend, Sara. Did you get to do anything fun?
You know what? I finally got to go out to eat this weekend at Virginia Beach, some open patio dining. So that was probably the highlight of my month so far. How about you?
Yeah, I just took it easy at home. Got to spend some time outside, and hopefully, so far the weather in Virginia has been pretty mild, which is nice. At this time it's usually pretty hot and sticky, so we'll take what we can get, right?
Oh yeah.
But glad to hear that businesses are opening up, and as a result of that, it looks like the market's starting to open up a bit too. We noticed a couple of notable breakouts today. You want to start with the Dow?
Yeah, so the first breakout that we kind of noticed here, the default chart of the Dow, we did see a breakout on that particular chart or that particular scale, which on the left-hand side, you can click on default to get that view. But for this particular view we're going to discuss today is the longer-term 500-point scale or 500-point per box chart. And just you click on this 500 here right at the bottom of other scales. And you'll see this particular chart today broke a third consecutive double top at 25,000, and this move also flips the trend back to positive for the first time since it flipped negative back in late February. So this long-term chart, showing some signs of improvement, and we also saw a very, very similar breakout today on the longer-term chart for the S&P 500. So if you pull up the chart of the SPX, similar to what we just did with the Dow, if you click on 50-point, again, this is just taking a step back. This is a longer-term view. This particular chart also broke a third consecutive double top today at 3,000. So these big significant milestones: 25,000, 3,000, third consecutive buy signal. This particular chart had moved back into a positive trend earlier this year, last month. So these are just more, absolute signs of improvement for just the overall market.
And something we definitely want to see, right? And, coming off of the March sell-off that really shook investors worldwide, offering these signs of confirmation off those near-term bottoms, it's been worth the patience to see the consecutive buy signals, and now we're starting to see the continued follow-through as we continue these breakouts. So, definitely worth looking at those index charts on a longer term basis just to get a little bit more of a longer term view, right? Drowns out some of the noise. Obviously, markets have been volatile. So you can always set an alert on these charts as well with their modified scale, which can be done at the top left-hand corner of the chart page at that set alert button. But one thing that's been interesting about this market environment, Sara, is just how well the leaders within the equity space have held up, right? And namely, if we look at momentum-based strategies, we've seen a continuation of strength. Obviously, seeing broad market selling pressure throughout Q1 and early parts of Q2, but for the most part, we've just been able to really continue on through, right? And one example of that is FV.
Yeah, so FV, the First Trust Focus 5 ETF, so that's the First Trust fund that follows the same underlying index as the First Trust Focus 5 model. This particular model we've seen, with today's action, it looks like this should be back in the black for the year. This is a sector, a sector strategy that really has, has overweighted the stronger areas that have continued throughout the year to be those stronger areas. We haven't really seen much of a shift there with, technology. We've seen one change so far through all of this volatility when we saw financials removed and healthcare stocks or the healthcare sector was added. Today's breakout, breaks through that resistance at 31. Now we're sitting at 31.50. And the next level of overhead resistance is at 34, which is the fund's all-time high that was reached back in February. And that strong score of 4.87 with a positive score direction of 1.85 just tells us that we've really been seeing both absolute and relative improvement over the past 6 months.
Absolutely. And again, this model, or this ETF rather, tracks and model on our site, the First Trust Focus 5 model. So I'm sure many of you are familiar with it, but of course you can follow it in that paper model format or via the single QSIP as we referenced here in the ticker FV. You know, and Sarah, as you pointed out, in the black on the year, which is pretty remarkable given that even with today's action, the Dow Jones Industrial Average is still down by more than 12 percentage points, as the S&P 500 is also still in the red on the year. So momentum has done its job on a year-to-date basis, really able to hold those leader positions. And as you mentioned, rotating out of the laggards, financials definitely being a weak spot in the broader market. And when we look at some of the other themes from an overall macro perspective, it's good to just kind of come back and take a look at how the different size and style categories are faring within the domestic equity universe, right? And as we mentioned, technology maintaining that leadership spot, throughout this environment. Really no surprise there that then you've seen the large growth area of the market scoring well. And this is on our asset class group score page, which is found under asset allocation on the Dorsey Wright platform. And from here, we're looking at different asset class groups ranked by their respective fund scores from their underlying constituents. The fund score looks at trend, relative strength, and relative strength for the market and relative strength to the peer group of the fund. And that score ranges from a 0 to 6, with 6 being the best. And what's notable here, Sarah, is that we've seen the large cap growth and mid cap growth are the only two size and style categories that are above that 4.0 score threshold, or that blue group, which is what we consider to be optimal. And you'll notice below the S&P 500, or what we call the U.S. equity core, is inching up toward the upper end of the green group at the 3.67 score, and displays a rank of 21 out of the 135 groups that we have if you were to fully expand this tool. So again, just a good place to come and have some historical and current market context regarding strength and weakness in the market. You'll notice that the value style is, for all of the different size categories, is still in that red or lower area of the group score page. So we haven't seen the move to value or any kind of mean reversion within the value style, occur yet at this point. So that said, really, really good place to come to keep an eye on. We're also watching the strength of money market as an asset class, which just dropped below into the red group for the first time here recently. And if you can see in the top left-hand corner where it says money market percentile rank on the asset class group score tool, we're showing a reading of just north of the 35th percentile. So money market only outranking about 36% of other asset classes on the tool. And this is pretty notable given that we saw that reading get above 50 here recently, which gives us kind of a view of the overall turbulence in the market, right? We want to see money market stay lower relative to other asset classes. When that reading spikes up, you're typically in an environment where you need to at least be paying attention to the defensive posture that you might want to take, whether it's with asset classes that you have exposure to, or just in looking at where to put money to work. Always important to note where that money market rates on the overall tool and use it kind of as a floating barometer.
Well, thanks, Eric. I think this is going to be a brief, high-level overview of just what we've seen. Again, this is a shortened week, with today being Tuesday, May 26th. We hope you all had a fantastic Memorial Day weekend, and we look forward to speaking with you next week.